There is a financial weapon hiding inside the global system right now, one that most Americans have never heard of, and it has the power to wipe years of retirement savings off your account in less than 72 hours. Not a recession, not a rate hike, a trade. A specific, obscure, institutional trade that's been quietly funding the bull market you've been cheering for years. Before we dive in, I need to be clear. I am not a financial advisor. This video is for educational purposes only. Investing involves risk, so always do your own research before making any financial decisions. Oh, I'm talking about the yen carry trade. And right now, as of today, the Bank of Japan just raised its policy rate again to 1%. Let that sink in for a second. Because while you were stress shopping at Target, arguing with your landlord about rent, or just trying to survive until your next paycheck hits, something enormous just shifted in a Tokyo boardroom. And if history has anything to teach us, your Robinhood account, your 401(k), your index fund, none of it is immune to what happens next. So let's break this down from scratch, because you deserve to understand the machinery that's been quietly running underneath everything you own. Here's the simplest way I can explain this. Japan, for roughly 3 decades, has had near zero interest rates. That means borrowing money in Japan was basically free, like embarrassingly cheap. So what do giant hedge funds, institutional investors, and professional money managers do when they can borrow in Japan at almost nothing? They borrow massive amounts of yen. Then they convert that yen into dollars. Then they take those dollars and dump them into higher yielding assets. US stocks, US treasury bonds, tech stocks, crypto, emerging markets, you name it. That's the carry trade. Borrow cheap in Japan. Invest at a higher return somewhere else. Pocket the difference. Repeat it at scale. We're talking hundreds of billions of dollars. And you've got yourself a machine that's been pumping liquidity into American markets for years, without most everyday investors even knowing it existed. So what does this actually mean for you? It means a chunk of the bull market you've been watching in your 401(k). Those green numbers, those my retirement is on track moments, has been partially funded by borrowed yen, not by fundamentals alone. Not just by corporate earnings or American productivity, by a carry trade, by borrowed Japanese money chasing returns in your stock market. That should make you uncomfortable, and it gets more uncomfortable from here. Let's talk numbers, because this is where the story gets real. The Bank of Japan's policy rate was sitting at 0.75%, and they just raised it today to 1%. The highest it's been since 1995, 30 years. Meanwhile, the US federal funds rate is sitting in the range of 3.5% to 3.75%. That's a gap, we call it a spread, of close to 275 basis points, or nearly 3 full percentage points for years. That gap was the engine of the carry trade. You borrow at basically zero in Japan. You invest in something yielding 4%, 5%, 6% in America, and you're printing money. The math works beautifully until it doesn't. Because here's the thing nobody explains on your TikTok finance feed. The carry trade doesn't unwind slowly. It doesn't give you a warning email. There's no notification on your Robinhood app that says, hey, global carry trade deleveraging in progress, might want to sit down. It unwinds violently, suddenly, and all at once. Because when it starts to go wrong, every single investor in the trade is rushing for the same exit at the same exact time, and you're standing in the way of that stampede without even knowing it. I need you to remember one date, August 5, 2024. That's the day this already happened, and most Americans just chalked it up to market volatility and moved on. But what actually occurred was a mini preview of what a full carry trade unwind looks like. On July 31, 2024, the Bank of Japan unexpectedly raised its benchmark rate from around 0.1% to 0.25%, just 0.15 percentage points. That's it. That's all it took. Between July 29 and August 5, the Japanese yen appreciated by approximately 6%, and in response, global markets experienced one of the sharpest single-day crashes since 1987. Japan's Nikkei 225 dropped 12.4% in a single day. The S&P 500 fell 3% in one session. The VIX, which is basically Wall Street's fear gauge, spiked to 65, its biggest single-day spike ever recorded, exceeding even the panics of 2008 and March 2020. Bitcoin crashed from around $60,000 to below $50,000 in the span of 48 hours. And that was just a partial, incomplete unwind. Analysts at UBS estimated at the time that only about 50% of the carry trade had actually unwound. Only half. So what you saw on August 5, 2024, that gut punch that had people staring at their brokerage accounts, wondering what just happened, that was half the unwind. Half, and now the BOJ is raising rates again. Today to 1%. Let me translate what this means for the person trying to budget for a weekend out, dealing with car repairs they didn't plan for, wondering if they'll ever be able to buy a house. When the carry trade unwinds, here's the mechanical sequence. Every investor who borrowed yen has to buy yen back to repay that loan. To buy yen, they have to sell whatever assets they put the money into. US tech stocks, S&P 500 index fund, the exact things sitting inside your 401k right now. It's not personal, it's mechanical. They don't care that you've been contributing $200 a month for 7 years. They need liquidity. They need yen. And to get yen, they sell American assets fast at whatever price they can get. That's why the crash is so sudden. That's why there's no warning. And that's why an event in Tokyo, a decision made by a central bank most Americans couldn't point to on a map, can take years off your retirement timeline in 3 days. Is that fair? Absolutely not. But that's the system we're living in. Now let me give you the full picture of where we stand right now, because this is the hidden story most financial media is not connecting for you. Japan sold nearly $29. $6 billion worth of US treasuries in just the first quarter of 2026 alone. That's the largest quarterly reduction in nearly 4 years. And Japan's 10-year government bond yield has climbed to approximately 6%, a level not seen since the late 1990s. Why does that matter? Because for the first time in a generation, Japanese investors, pension funds, life insurers, banks can earn meaningful returns right at home in Japan in yen without needing to park money in US treasuries or US equities. Think about that for a second. The core logic that sent Japanese money pouring into American markets for decades. You can't earn anything at home, so you go abroad. That logic is breaking down. Japanese 10-year bonds now offer higher yields than currency-hedged US bonds. The math that built the carry trade is going negative. So what does this actually mean for you, the American investor? It means the flood of foreign money that's been quietly supporting your stock portfolio could be starting to flow the other way. Not because anyone panicked, not because of a financial crisis, just because the numbers changed, just because Tokyo finally started paying better. And there's a second, scarier layer to this. Japanese insurance companies, massive institutions with enormous holdings, have hedged only about 46% of their foreign asset exposure, which means they're sitting on a mountain of unhedged dollar assets. If the yen strengthens meaningfully from here, those institutions face mounting currency losses. And the way you fix a currency loss on dollar assets is you sell those dollar assets, US stocks, US bonds, the stuff your retirement is built on. Oh, let me ask you something. Think about how you felt in August 2024 when the market dropped 3% in one session. Maybe you checked your 401k and felt that sick feeling in your stomach. Maybe you told yourself not to look. Maybe you were younger and thought, it'll come back. Now imagine that same event, but 3, 4, 5 times larger, because the August 2024 episode was a practice run, and the underlying conditions that caused it haven't resolved. They've been building. Here's what the bulls will tell you. They'll say the carry trade is already significantly smaller than it was at its peak. Some analysts put the current yen carry trade at around $261 billion. Still enormous, but not the multi-trillion-dollar monster some headlines have suggested. They'll say the BOJ is moving slowly and deliberately, giving markets time to adjust. They'll say the rate differential, even after today's hike, is still nearly 275 basis points, still wide enough to keep some carry trade economics alive. They'll say smart money saw this coming and already repositioned. CFTC data showed net short yen positions declining significantly heading into this period as hedge funds repositioned. And honestly, those are fair points. This is not guaranteed catastrophe. Markets have known the BOJ was hiking for months. This isn't a 2024 style surprise, but here's the bearish case, and this is the one I want you to sit with. Carry trades don't fear today's rate. They fear tomorrow's path. The BOJ has now hiked to 1%, and the signal is clear. Normalization is happening, and it's going to continue. Every hike, every basis point makes the math slightly worse for the carry trade. And at some point, for some investor, the math tips. And when the first big player starts the exit, the dynamic becomes self-reinforcing. Yen rises. More people rush to cover. More US assets get sold. Yen rises faster. The feedback loop kicks in. It's not a question of if that loop can happen. We watched it happen in August 2024. The question is how big and how fast. Here's the part that makes me want to shake people awake. The average American investor scrolling their Fidelity app has zero idea this exists. You're thinking about whether your Apple stock is up or down, whether your index fund is keeping pace with inflation, whether you're saving enough for a down payment. And meanwhile, there's a $261 billion trade denominated in Japanese yen that has co-authored the bull market you're counting on for retirement. And it's slowly, gradually starting to come apart. This isn't some fringe theory. Morningstar's chief US market strategist flagged this as one of the key risks for 2026 back in January. Analysts have been writing about it. The BIS, that's the Bank for International Settlements, basically the central bank for central banks, has explicitly highlighted how carry trade unwinds can ripple across currencies and broader markets during stress episodes. They literally documented the August 2024 VIX spike in a dedicated bulletin, calling it the biggest single-day volatility spike ever recorded. The information exists. It's just not being packaged in a way that connects it to your life. So let me do that right now. You're making $75,000 a year. You've been contributing to your 401(n)(a) for 5-6 years. You've got maybe $40,000, $50,000, $60,000 in there. You're checking it once a month, feeling okay, telling yourself you're being responsible. Good, you should feel good about that. Contributing consistently is one of the best financial habits you can build. But here's what most people don't realize. In a carry trade unwind scenario, it doesn't matter how disciplined you've been. It doesn't matter that you dollar cost averaged through COVID, through 2022, through every dip. When institutional investors need to sell US equities fast to cover leveraged yen positions, your index fund goes down with everyone else's. Your 401(n)(a) doesn't get a special exemption because you're a retail investor who did everything right. That's not me saying to panic. That's not me saying pull everything out and hide it under your mattress. I'm not a financial advisor, and this is not advice. What I'm saying is, you deserve to know this exists. You deserve to understand the forces that can move your retirement account, because awareness is the first layer of protection. Now, let me tell you what the next 6, 12, 24 months could look like depending on how this plays out, because this is the part most people are sleeping on. If the BOJ continues hiking, and the expectation right now, as of today, is exactly that, the rate differential between Japan and the US continues to narrow. Some analysts at Commerzbank projected the US-Japan rate gap could narrow to around 150 basis points by the end of 2026 if the BOJ keeps hiking and the Fed stays flat or cuts. That's roughly half the current spread. Carry trade economics get dramatically worse. On the 6-month horizon, if we see continued yen strengthening, watch for more volatility in US tech stocks specifically. The Magnificent Seven, the mega-cap tech names that have driven most of the index gains in recent years, were heavily funded by carry trade liquidity. When that liquidity retreats, they feel it first and hardest. Your index fund is heavily weighted toward those names. On the 12-month horizon, if Japan's domestic yields keep rising and Japanese institutional money genuinely starts repatriating, the US Treasury market faces pressure. Rising Treasury yields, caused partly by reduced foreign buying, means mortgage rates could stay elevated or even tick back up, even if the Fed is cutting, which means the housing affordability crisis that's already crushing millennials and Gen Z doesn't get better. It might get worse. Your rent trap could last longer than you planned. On the 24-month horizon, and this is the hidden story, if a significant carry trade unwind coincides with any other macro shock, a recession, a credit event, a geopolitical flare-up, the combination could produce the kind of prolonged drawdown that genuinely delays retirement timelines. Not 3 days of pain and recovery. Months of grinding lower. But again, let me be fair. That's a scenario, not a prediction. Markets recovered from August 2024 within weeks. The US economy is resilient. The Fed has tools, and a lot of the carry trade unwinding may already be priced in. Some analysts argue the risk has been overblown. So here's the question I want to leave you with. Are you comfortable with the fact that your retirement account has exposure to a trade you've never heard of? One that can move against you in 72 hours, and your financial plan doesn't account for it at all? Let me give you the other side of this. The argument that this is all overblown, because I think you deserve to hear it fairly. There's a credible school of thought that says the yen carry trade is actually much smaller and more manageable than the scary headlines suggest. One analysis pegs the actual size of yen-funded carry positions at around $261 billion, not the trillions sometimes referenced. And with months of BOJ signaling, a lot of smart institutional money has already reduced exposure. CFTC data showed speculative short yen positions declining substantially through late 2025 and early 2026. The surprise factor, which is what made August 2024 so violent, may simply not be there this time. The counter-argument to the counter-argument: size isn't the whole story. Leverage is. Carried trades are almost always leveraged, meaning the positions are far larger than the underlying capital. When leveraged positions unwind in a correlated way, even a small trade can cause massive price dislocations. And the BIS has specifically highlighted that it's the crowdedness and leverage of carry positions, not just their size, that drives the ripple effect through global markets. So we're kind of back to square one, which is exactly where macro risk lives. Nobody knows when or how bad. What we know is the conditions for it exist right now. Let's zoom out for a second. Because this whole situation is, well, let me rephrase that. It's not just a carry trade story. It's a story about how deeply interconnected global financial markets have become. The decisions of a central bank in Tokyo affect the price of your Costco stock. The interest rate paid by a Tokyo pension fund affects whether your 401k has a good quarter. A currency you've probably never held in your hand, yen, influences the market value of the index fund you've been faithfully contributing to every 2 weeks. That's the world we're in. And the average American has absolutely no framework for understanding it. We're taught to save. We're taught to diversify. We're told to invest for the long term and don't time the market. All of that is still broadly true and useful advice for most people's financial situations. But none of it comes with an asterisk that says, warning, your long-term returns are partially dependent on a carry trade funded by borrowed Japanese yen. And if that trade unwinds violently, the short term can be genuinely brutal in ways that are impossible to predict. Why don't we talk about this stuff? Why is it buried in analyst reports that most people will never read? Here's something else I want you to understand about how the feedback loop actually works in real time, because this is the mechanism that keeps me up at night when I think about carry trade risk. When the yen starts to strengthen, which happens naturally as BOJ raises rates, carry traders face what's called a margin call. Their borrowed yen is now worth more relative to the assets they hold. The math of the trade deteriorates. To stay solvent, they have to sell assets to raise cash to cover the position. But here's the problem. They're all selling at the same time. US tech stocks, US treasuries, emerging market bonds, everything goes on sale simultaneously. And because they're all selling the same assets at once, prices fall faster than any individual trader anticipated. The falling prices cause more margin calls. More margin calls cause more selling. More selling causes more price drops. It's a doom loop. And it moves at machine speed, not human speed. By the time you notice your portfolio is down 5%, the institutional players have already done most of the damage. That's why August 5, 2024 felt like it came out of nowhere. Because for retail investors, it literally did. The mechanisms were invisible to them. The unwinding had started days earlier in the currency markets, but unless you were watching USD JPY like a hawk, you had no idea the floor was being pulled out from under your equities. So here we are. June 16, 2026. The BOJ just hiked, again to 1%. Japan's 10-year bond yield is at levels not seen since the late 1990s. Japan sold nearly $30 billion in US treasuries in just the first quarter of this year alone. The rate differential between Japan and the US is narrowing. The fundamental logic of the carry trade, free money from Japan, higher returns in America, is eroding month by month, hike by hike. None of this guarantees a crash. I want to be crystal clear about that. Markets can absorb a lot. Institutions adapt. The carry trade has been unwinding in a slow, managed way for over a year, and markets have survived. The people who called for immediate catastrophe after every BOJ hike have been wrong so far. But the risk is real. The mechanism is real. The precedent, August 2024, is real. And the question isn't whether this could happen. It's whether you know enough to not be blindsided if it does. Let's talk about what a prepared, informed person looks like. Not a panicked person, not someone yanking everything out of the market, but someone who actually understands what's happening and can ask the right questions. You start by understanding your actual exposure. If you're in a target date retirement fund or a broad S&P 500 index fund, you have significant exposure to large cap US equities. Those are exactly the assets most susceptible to a carry trade unwind. That doesn't mean they're bad investments. It means you know what you own. Then you start thinking about time horizon. If you're 28 and your 401k takes a 20% hit over 3 months and then recovers over 3 years, does that actually derail your retirement? Maybe not. But if you're 57 and 5 years from retirement, a violent multi-month drawdown changes the math on your timeline in ways that are hard to recover from. The same risk hits different people differently. That's not investing advice. That's just math. And you start actually reading, not just checking your account balance. Reading. What is the BOJ doing? What is the Fed signaling? What is the yen doing against the dollar? These are public, free pieces of information. They're not hidden. They're just not packaged in a way that makes them feel relevant to your life, but they are relevant to your life. I just spent this entire video proving it. And here's the question I'll leave you with, and I genuinely want you to think about this, not just scroll past it. Most people who are contributing to a 401n, saving in index funds, building toward retirement, they have no idea the yen carry trade exists. They've never heard of the BOJ. They couldn't tell you what a carry trade is if their financial future depended on it. And yet, in a very literal sense, their financial future does depend on it. Is that okay with you? Is that a system you feel comfortable trusting your retirement to? One where billion-dollar institutional trades you've never heard of can crater your account value in 72 hours, and nobody on the news will explain why. Because if the answer is no, then the work starts now. Not with a trade, not with a sell order, not with a hot take about what the market is going to do. The work starts with financial literacy, with understanding the actual architecture of the system you're participating in, with reading a 10K, watching a monetary policy press conference, understanding what a basis point is and why it matters. That's boring. I know it's boring. It's not as exciting as a stock tip or a meme coin, but it's the actual work. And the people who do it, the people who understand what the yen carry trade is, who watched August 2024 and understood why it happened instead of just riding the wave of panic, those people aren't immune to the volatility. But they're not blindsided by it either. And that difference, being informed versus being blindsided, might be the most valuable financial edge you can build right now, for free, without a financial advisor, without a brokerage account, just by paying attention to the machinery of the world you live in. Don't take my word for any of this. Go read the BOJ's policy statements. Look up what happened on August 5, 2024. Google yen carry trade unwind. Read Morningstar's analysis, the Biz reports, the CFTC positioning data. The information is out there. It's public, it's free, and it's about your money. Stay curious. Stay skeptical of me, of everything, and keep building your financial knowledge one video at a time. Because in a world this complicated, awareness is the only edge that actually belongs to you.